Bonds just snapped in a way you don't unsee. And the scary part is it's not about one Fed soundbite or one headline. It's about trust collateral and forced selling. And once that flywheel spins up, the market starts telling you the truth in places most people never look. The price is lying. The stress isn't. Hang on, later in this video, I'm going to give you the exact next 2 weeks checklist. What level matters? What confirms this? What breaks the thesis? And the one calendar window where funds and dealers are most likely to be forced into the same trade at the same time, because that's where the real pressure starts. Here is what everyone keeps missing. A bond crash isn't just a bond story. It's the plumbing of the entire financial system getting shoved sideways. And when the plumbing shifts, the so-called safe assets can become the thing that creates risk. That sounds backward until you understand what a treasury actually is in modern markets. It's not just an investment, it's collateral. It's the base layer of leverage, repo, hedging, and liquidity. So when the long end gets hit hard and fast, when yields jump in a few sessions instead of a few months, everybody who lives on small moves, high leverage, has to reprice their survival. Not their opinion, their survival. And that S when gold and silver stop being pet rocks and start acting like alternative collateral, you can T-print. But that's not the part that matters. The part that matters is why it's happening right now, why it accelerates into specific dates, and why the people dismissing metals as emotional are about to be the ones trading on pure emotion. Let's translate the bond move into plain English, because the media loves to say yields rose like it's weather. When bonds sell off, yields rise, and the faster that happens, the more violent the mark-to-market losses are for anyone holding duration. Duration is just a fancy way of saying sensitivity to rates, and a lot of the financial world is basically a duration machine. Banks own it, pensions own it, insurance owns it, funds own it. And, more importantly, a lot of strategies are built on the idea that treasury volatility stays contained. When volatility doesn't stay contained, the rules change. That's why this move feels different. Even if the yield level itself isn't a historic extreme, the speed can be. And speed is what forces behavior. It's what turns portfolio adjustment into liquidation. It's what turns diversify into sell whatever has a bid. And when that happens, you stop getting clean correlations. You get broken correlations. You get gold up while yields are up. You get silver acting like it is both a safe haven and a leveraged call option on scarcity at the same time. You get people screaming, "This makes no sense," which is usually the market's way of telling you the old model just expired. Now, what's the public story? The public story is always a headline. Trade tensions, political noise, inflation chatter, a hot data print, a cold data print. Somebody said something. Somebody hinted something. Fine, those are sparks. But sparks only matter when there's gasoline. The gasoline in the treasury market is a stack of structural pressure that SEST's been building. Massive issuance needs a market increasingly dependent on dealers and balance sheets to intermediate. Foreign demand that can be fickle when currency risk shifts. And a big chunk of investors who don't own bonds, they own a risk parity model, a volatility target, or a carry trade. And models don't have pride. Models have triggers. When the trigger hits, the model sells. Period. And that's where the real pressure starts. Because when models sell treasuries, they don't just sell treasuries. They sell equities. They sell credit. They sell anything that frees up margin. And suddenly, your safest asset becomes the weight that drags everything underwater. That's why I'm calling this a collateral shock, not just higher yields. Here's is the underappreciated mechanism that reframes everything. Treasuries are the collateral that lets the system run hot. They're posted in repo. They're used to secure financing. They're the thing you pledge so you can do everything else. When their value drops sharply, lenders get nervous. Haircuts rise. Risk limits tighten. The system demands more collateral for the same exposure. That's not a philosophical debate. That's an email from a risk desk. That's a margin call. That's a fund manager staring at a screen with two choices: add cash or cut positions. And most of the time, the only thing they can do fast is cut. Now pause and let that sink in. In a bond sell-off, the world is not just preferring cash. The world is being forced into cash. That's a very different vibe. And that forced behavior is exactly why gold and silver can become the only safe havens that matter in that moment. Not because they can't drop. Oh, they can drop violently, but because they're not somebody else's liability. They're not a promise. They're not a duration instrument that blows up when discount rates gap. They're just metal, sitting there, refusing to care what the bond market does. And when trust and collateral are the actual story, that stubbornness becomes a feature, but that's not the part that matters. The part that matters is how this plays out on the calendar, because markets don't just move on narratives, they move on deadlines. And right now we're moving into a tight, awkward window. A Federal Reserve meeting in late January, a Treasury refunding announcement in early February auctions that can expose weak demand, and a market that's still digesting where the neutral rate actually is. In these windows, liquidity thins. Dealers get careful, funds rebalance, risk managers get louder, option books roll, and the moment you put a stressed bond market into thin liquidity, you get air pockets. That's how gradual repricing becomes gap. That's how a manageable move becomes a headline move. And that is exactly when metals can do something that makes people furious. They can rise, not because the world is optimistic, but because the world is fragile. Now, let's talk about the part nobody wants to say out loud. The long end of the Treasury curve isn't just pricing growth and inflation, it's pricing credibility. It's pricing whether the buyer of last resort is there. It's pricing whether the fiscal path feels stable. It's pricing whether the political environment makes future policy predictable or chaotic. And when that credibility premium rises, you get something that looks like the risk-free rate, demanding a risk premium. That's when the safe asset stops being soothing. That's when it becomes a source of volatility. And this is where gold starts to look less like a commodity and more like an alternative monetary asset. Because gold is not primarily a bet on CPI next month. Gold is a bet on the integrity of the whole stack. Real yields, currency stability, and political credibility. The simplest way to say it is this. When the world is confident, gold is optional. When the world is uncertain in a structural way, gold becomes collateral for the human nervous system. But that's not the part that matters. The part that matters is why gold can rise even when yields rise, because that's what confuses people and makes them dismiss the signal. If yields are up, gold should be down. That's a clean textbook relationship, and textbooks assume stable regimes. In a regime where the bond market itself is the unstable thing, gold can behave differently. If yields are rising because growth is ripping, and real yields are rising in a stable way, gold can struggle. If yields are rising because term premium and credibility risk are rising, gold can rise with them. Because then gold isn't competing with yields, it's competing with trust. And trust doesn't pay a coupon. Trust either exists or it doesn't. When trust is questioned, a higher coupon on a liability doesn't automatically win. Sometimes it loses harder. Now let's talk about silver, because silver is where this story gets savage. Silver is not gold's polite cousin. Silver is gold with a live wire attached. It has monetary demand vibes when fear rises, but it also has industrial demand, and that dual identity makes it prone to violent squeezes and violent rug pulls. That's why silver can feel like it's possessed. And it's also why, in a bond-driven collateral shock, silver can be the thing that rips when the system needs a real asset, but also senses a supply chain bottleneck. Because if gold is a trust hedge, silver can become a trust hedge plus a procurement hedge. And that's where the real pressure starts. Here's the hidden detail inside the silver story that most people miss. It's not always about a global shortage. It can be about wrong place, wrong time. You can have enough silver in the world in aggregate, but if it's sitting in the wrong vault system, in the wrong form, with the wrong delivery terms, it might as well not exist for the market that needs it right now. That's how you get paper prices doing one thing while physical premiums whisper another story. That's how you get sudden tightness, frantic shipping in a market that feels like it's being pulled by a magnet you can TC. The mechanism is simple and brutal. If there's a price gap between two regions or two delivery systems, arbitrage should close it. Buy cheap here, sell expensive there. But arbitrage requires three things: financing, logistics, and confidence that the spread will still exist when the metal arrives. When financing gets tight because the bond market is stressing collateral, arbitrage gets harder. When logistics are slow, arbitrage gets delayed. When confidence is low, traders demand wider spreads to even try. So the normal force that would keep prices aligned becomes weak. And when that force is weak, price discovery gets sloppy, it gets jumpy, it gets violent. And silver, because it's smaller and thinner than gold, tends to show you that violence first. But that's not the part that matters. The part that matters is how to tell whether this is real or just hype. You don't do it by vibes, you do it by proof stacking. You look for multiple independent signals that all point in the same direction. Here are the tells, translated into human language without pretending we have magical omniscience. First tell: the bond move is fast, and it's happening in the long end where credibility premium lives. Second tell: volatility is rising in rates, which tightens financial conditions even if the Fed doesn't move a muscle. Third tell: the dollar's behavior becomes unstable. Sometimes it spikes on stress, sometimes it wobbles on sell America fear. And that instability itself pushes people toward assets that Dawn and T rely on any one government OS promise. Fourth tell: you start to see persistent demand for precious metals through the channels that matter for allocation: ETFs, institutional products, and large bar demand, especially when dips get bought quickly. Fifth tell, you see physical market symptoms, which can show up as tighter availability, higher premiums, vault flows, or persistent chatter about sourcing, even if spot is still noisy. Sixth tell, you see cross-market confirmation, gold strong, not just in dollars, but also holding up in other currencies, which suggests it's not only a dollar story, it's a trust story. Any one of those can be a head fake. When you get 4, 5, 6 at the same time, it's the system talking. And that's where the real pressure starts. Now I want to interrupt the narrative with mechanics, because this is where most retail investors get played. Metals are not a straight line. They are a battlefield between leveraged paper positioning and physical reality, with options acting like gasoline. And even if you never touch an option contract in your life, options can touch you because they affect dealer hedging, which affects price acceleration. Here's the clean version. When a lot of call options are bought on gold or silver, dealers who sold those calls hedge by buying the underlying as price rises. That buying can accelerate a move, especially if the market gets into a zone where gamma is high. Gamma is just the rate at which delta changes, and if you don't want the Greek soup, just remember this. In certain price zones, dealers are forced to chase more aggressively. That can create a reflexive loop. Price up, hedging buy, price up more hedging buy. It doesn't last forever, and it can reverse brutally, but it can create those why is this ripping? Well, days that feel detached from fundamentals. Now add the bond collateral shock into that. If the bond market stress reduces risk appetite and reduces willingness to warehouse risk, liquidity and everything thins. Thin liquidity plus reflexive hedging is how you get vertical moves. That's why I'm not telling you metals only go up. I'm telling you the setup is structurally unstable. And in unstable setups, moves can be sharper than you expect in both directions. But that's not the part that matters. The part that matters is the why now trigger, because the next 1 to 2 weeks are where a lot of the forcing functions sit. Late January is a classic zone for repositioning. You've got the Fed meeting that can shift the tone on inflation, growth, and the path of policy. You've got the market staring at auctions and refunding chatter, trying to guess how much duration supply is coming and who is going to buy it. You've got funds that are either sitting on gains they need to protect or sitting on pain they need to stop. You've got dealers managing balance sheet into month end. And when month end is near, rebalancing flows can show up in ways that look irrational if you're only watching headlines. That's why the calendar is the catalyst. Not because dates have magic, but because dates force behavior. People can argue about narratives forever. People can't argue with a deadline. Now, let's put a hard edge on the conflict in this story because it's not bonds versus gold. The real conflict is paper promises versus real collateral in a world where the most important paper promise is being repriced in real time. Institutions don't wake up and say, I want to manipulate gold. That's cartoonish and legally spicy and usually wrong. Institutions wake up and say, I have risk limits, I have liabilities, I have collateral requirements, I have VAR, I have margin, I have a mandate. And then they do what their incentives force them to do. If bond volatility rises, they either hedge more, reduce exposure, or rotate into things that behave differently. Gold and silver benefit when they behave differently, especially when the different is not correlated to the collateral that is breaking. That's the hidden mechanism. That's why you can see gold and silver look like the only safe havens left, even if they still whip around. Because safe haven in a crisis never goes down. It's not reliant on the system that's under stress. Okay? But that's not the part that matters. The part that matters is how you, as a retail investor with a fragile attention span and a healthy skepticism of institutions, stay alive through the volatility. Because this is where the market will try to emotionally mug you. It will pump the narrative when price is extended. It will declare the trade dead on the first ugly pullback. It will use volatility to separate you from your plan. And if you don't have a plan, you become liquidity. You become the person selling to the buyer who actually understands the structure. So here's your psychology shield, and it's not motivational, it's tactical. Step 1, separate trend signal from noise. Noise is intraday whipsaw, headline churn, and the first reaction to a data point. Trend signal is what happens after the dust settles. Does price hold key levels? Do dips get bought? Does the market make higher lows? Does it reclaim broken levels quickly? Do spreads calm or worsen? Does the bond market stabilize or keep gapping? Step 2, pre-commit to 2 scenarios, not one prophecy. Scenario 1 is the controlled pullback and retest. Scenario 2 is the continuation squeeze with gap risk. If you only believe one story, you'll get emotionally hijacked the moment the other story starts happening. If you accept both, you can act instead of react. And that's where the real pressure starts, because when you stop reacting, you stop feeding the machine. Now let's build the near-term roadmap, because this is the payoff. Scenario 1, controlled pullback and retest. In this scenario, bond yields stop accelerating. They might stay high, they might grind, but the pace slows. Auctions come in okay, not glorious, just okay. The Fed doesn't shock the market. The dollar stabilizes, and gold and silver pull back, not because the thesis is wrong, but because momentum got stretched and the market needs to reset positioning. In that case, what you want to see is not green candles. What you want to see is structure. Gold holds its most recent breakout zone, whatever that is on your chart. Call it the area where it last launched higher. It dips into it, it gets bought, it doesn't collapse through it for days. Silver, being silver, will overshoot both directions. It might drop harder, scare more people, and then snap back if the bid is real. Confirmation. In scenario 1 is simple. The pullback is sharp but contained and the recovery is fast. That tells you buyers are waiting. It tells you the metal is being used as a stash, not just a trade. Weakening in scenario 1 looks like this. Gold loses its key support, fails to reclaim it quickly, and starts making lower lows while bond stress actually eases. That would suggest the bid was mostly positioning, not structure. And that's where you tighten up your story and stop forcing it. Now scenario 2, continuation squeeze and gap risk. In this scenario, bond yields keep pressing higher or keep whipping in a way that screams instability. Liquidity stays thin, dealers stay defensive, risk limits tighten. And then something happens. An auction is sloppy, a policy tone surprises, a geopolitical escalation jolts markets, a big fund gets forced to de-risk. Suddenly, metals don't just drift up, they jump. Because in this scenario, gold isn't competing with yields, it's competing with collateral fear. And silver, in particular, can go from annoying to violent because it's a smaller market and it's more sensitive to reflexive flows. Confirmation in scenario 2 is not a big up day. It's follow-through. It's metals rallying, even while risk assets wobble. It's dips being shallow. It's price holding above breakout levels instead of immediately mean reverting. It's that feeling that the market is chasing, not offering. And if you see that, you respect it. Because these are the phases where people get stubborn and get run over. But that's not the part that matters. The part that matters is the levels and invalidation triggers. Because if you don't define what changes your mind, the market will define it for you. And it will do it at the worst possible price. So here is a clean way to think about it without pretending we can pick the top tick. Watch the bond market first, because it's the source of the stress. The key question isn't, are yields high? The question is, are yields accelerating? If the 10-year and the long bond keep pushing higher in a way that feels disorderly, big daily ranges, fast repricing, that supports the collateral shock thesis. If yields stabilize and volatility compresses, metals can still do well, but the urgency fades. Second, watch the dollar. If the dollar is ripping because global risk is panicking, gold can still rise, but it can get tugged. If the dollar is wobbling because confidence is being questioned, that tends to be cleaner fuel for gold. Third, watch how gold behaves on red days. Does it get dumped like a risk asset, or does it hold better than everything else? Fourth, watch silver's recovery speed after a hit. Silver will get hit. That's what it does. The signal isn't whether it gets hit, the signal is whether it snaps back quickly and whether the lows keep stepping up over time. Fifth, watch the paper to physical vibe, even if you're not reading vault reports every morning. Are premiums staying firm? Is retail availability tightening? Are large buyers treating dips like gifts? Those are the ground level symptoms that matter more than a hot take. And here's your invalidation idea in one sentence. If bond volatility eases, auctions are strong, the dollar stabilizes, and gold still can't hold key support zones, then the only safe haven left framing weakens. Not because gold is dead forever, but because the immediate catalyst was stress, and stress is fading. That's how you stay honest. That's how you keep trust with yourself, which is the only trust you can actually control. But that's not the part that matters. The part that matters is what this forces institutions to do, because institutions are the whale current underneath your little boat. In a collateral shock, institutions do a few predictable things. They reduce leverage. They shorten duration. They rotate into more liquid, less balance sheet intensive exposures. They buy hedges that work when correlations break. And they quietly increase allocation to things that are not someone else's liability. Sometimes they do it directly. Sometimes they do it through proxies. Sometimes it shows up as mysterious demand. It's not mysterious. It's incentives. Now add the central bank layer. Central banks don't chase day-to-day moves, but over time, a world that feels more fragmented and more sanction-aware tends to diversify reserves. That doesn't mean gold goes up in a straight line. It means there's a structural bid underneath the noise, and that's why the gold is just sentiment crowd keeps getting surprised. Because sentiment doesn't quietly accumulate over years. Policy does. Now, I'm going to say something that will irritate both camps. Gold and silver can be the only safe havens left and still hurt you. Because safe haven is a role, not a promise. In a violent deleveraging, everything can get sold for cash, including gold. That's happened before. Silver can drop like it's been unplugged. That doesn't invalidate the structural thesis, it just means the path is not polite. So if you're the kind of person who needs constant emotional comfort from your chart, metals will punish you. If you're the kind of person who can operate off a plan, levels, scenarios, time horizon, metals can be a powerful hedge when the bond market is the source of instability. That's the trade-off. That's why this isn't a get-rich-quick story. It's a stay solvent and see the regime story. And that's where the real pressure starts. So what do you do with this week? You don't chase your own adrenaline. You build a watch list and you let the market come to you. You mark the recent breakout zones in gold and silver on your chart, and you watch whether they hold on retests. You monitor whether bond yields are stabilizing or accelerating, especially into and out of the late January policy window and the early February Treasury communication window. You pay attention to auction tone, not because you're trading the auction, but because it's a real-time referendum on demand for duration. You keep your position sizing sane because volatility can whip around violently, even if the thesis is correct. You treat big spikes as potential forced buying, rather than proof that you wonderfully discovered a cheat code. You treat ugly pullbacks as structure tests, rather than moral judgment from the universe. And you remember the simplest truth in markets. The crowd is most confident right before it messed wrong, and most fearful right before it's early. Your job is not to be fearless. Your job is to be prepared. But that's not the part that matters. The part that matters is the one metric everyone should watch if you want to know whether this is turning into a real squeeze versus just a noisy rally. The behavior of liquidity and volatility around key levels. Not the narrative, not the hot take. Liquidity and volatility. If volatility rises and liquidity thins and price still pushes higher, that's usually forced behavior. If volatility rises and liquidity thins and price fails and bleeds, that's usually exhaustion. Those are two very different regimes, and they can flip quickly around calendar catalysts. So you don't marry a thesis. You date it with boundaries. You keep receipts. You keep your mind flexible without being weak. And you let the market prove itself, not in one candle, but in how it behaves when it's supposed to fail. If gold is supposed to fail on higher yields and it refuses, that's information. If silver is supposed to collapse after a spike and it keeps finding buyers, that's information. If bonds are supposed to be safe and they're the thing creating margin stress, that's information. The market is always telling you what the real safe haven is. This week, it's whispering that the definition is changing. If you're the kind of person who wants to understand the mechanism instead of worshiping the ticker, you already know what to do next. Build the checklist. Watch the calendar, respect the two scenarios, and don't let volatility rent space in your head for free. And if you want to roll with a community that treats finance like engineering, mechanisms, incentives, proof stacks, and risk management, stick around, because the next few weeks are going to expose who watching headlines and who watching structure.